But topic 5, statement of cash flows. What I've handed out is a copy of Woolworth's consolidated statement of cash flows for 2015. We will refer to that in just a second. But to give you a higher order view of what we're doing today, and I know we've got 6 objectives listed out here, but I think we can distill these into basically 2, which is basically lecture objective 1, which is just understanding why we have a statement of cash flows and what we do with it. 2 to 6 basically talk about the process of creating one, which is obviously really important if you're going to be on the preparer side, and it's going to be important for us, in this course. But the first one is going to be important for you if you're going to be on the preparer side. It's going to be important for you if you want to be looking at these companies. That's just a generally an important thing. So when we look at the statement, and we will do that in a moment, Woolworths started the year with about $900 million in cash. And you can see that. If you look at that statement, you can see that right down the bottom. They started with about $900 million in cash, and they ended the year with about $1,300 million. That's a really bad way of saying $1.3 billion. So the thing is, we don't even have to look at that statement. If we looked at the balance sheet, we would see cash and cash equivalents started at 900 odd, finished at 1,300 odd. I can see that clearly, that it's been an increase in cash of about 400 million without having to look at a whole separate statement. Which begs the question, and I know we talked about this about 4 weeks ago, which begs the question, why do we need to look at it when we already know what the start and end points are? We can look somewhere else. Yeah, how do they generate? And as you can see looking through it, and we will spend some time looking over it, just seeing the net effect of something isn't that useful. We want to see how they generated their cash, what different things they got their cash from, what different things did they spend cash on. Because how you generate it, you may have cash coming in, but if you generated that cash by selling product, if you generated that cash by borrowing money, if you generated that cash by selling property, plant, and equipment, all of those 3 things will generate cash for you. And it could generate the same amount of cash, but they're not the same. And if we're going to invest in this business, if we're looking at this business to do something with, we want to know where they're getting their cash from. That does change our perception of them. So it is important to delve within to see what's going on. So describe the purpose and format of the statement of cash flows. The statement of cash flows reports the impact of a firm's operating, investing, and financing activities on cash flows during the accounting period. Some would say that the statement of cash flows is one of the most important of the 4 required financial statements. Generally, the people who will say that cash flows are important are finance people. If you're doing finance, if you've come across finance stuff before, if you were to Google cash versus profit, there'll be a whole bunch of articles, because I've done this, on why cash is so much better than profit. If you may have heard of the term cash is king. Look, and I don't disagree with cash being important. You can't use profits to buy stuff. You use cash to buy things. So ultimately, you can generate profits, but it's got to turn into cash at some point. That's ultimately where it's got to go. So I understand why people have a bit of a concern with it. The other angle is, you may have seen this before, you may not. What does that equal? If you're an accountant, it doesn't. You can make it whatever you want it to be. And that's a concern, because what we see is, as we've come across in depreciation last week, as we come across in allowance for doubtful debts, as if you go off and do more technical accounting, you'll come across lots of different places where this happens. There is judgment involved, there is estimation. It's not black and white. And when it's not black and white, we can start to play around with profitability. If we want to increase our profit, you extend out the useful life of an asset. You extend that useful life out, you reduce your depreciation expense. You reduce your depreciation expense, you increase your profit. Nothing has changed. You just made a change on a spreadsheet somewhere and your profit increases. That's the concern people have with profit. And I share that to a degree, but I still think it serves a useful purpose. The cash flow statement allows us to see it in a slightly different vein. And I'll show you how they can be used quite effectively together. So the statement of cash flow summarizes a company's inflows and outflows over a period of time, how and why a company's cash balance changed over the years. Can it generate sufficient cash? If it can't, it's going to run into problems. And you just have to look at Dick Smith. They ran out of cash. That's why, there were strategic decisions that were made that caused that to happen. But ultimately, they got to a point around December last year, January this year, where they weren't going to be able to pay for things. They weren't going to be able to pay suppliers, where they were going to run into trouble. They were trying to make sales happen. That wasn't bringing in enough cash. They went to their banks to borrow money, and the banks just went, we're not touching you anymore. And because the banks turned them down, that's it. They had to roll up the shutters. So generating cash is ultimately really important. You can even see some information about things which affect the balance sheet but don't show up on the income statement. So buying and selling property, plant, and equipment. We see operating, investing, and financing activities. We'll have a look at what those are in a moment. And on that point, we'll have a look at, if you can pull out the statement of cash flows. So this is a consolidated statement of cash flows for Woolworths. I'll make this a bit smaller. I'll go to the document camera. So let's have a look over this, because there's no better way to have a look at these things than actually having a look at them. So there we go. So what we have here is a really typical statement of cash flows. We've got 3 different sections. And I'm going to talk about this stuff now, and as we get to those particular points in the slides, we'll skip over it a little bit because I will have already talked about it. So operating activities, investing activities, financing activities. So operating activities are what you'd expect them to be about the operations of the business. So it's just, I suppose what the business does. And you can see in this case, the 2 biggest cash flows by far are what they get from customers coming in and what they pay to suppliers, employees, all that sort of thing going out. 65 billion in, 61 billion out. No question, that's the biggest. We have financing costs, or basically interest for our purposes, and income tax paid. So interest and tax. I will talk about these at the end. $3.345 billion. So just by doing their operational side of things, classifying operating cash flows, they're cash flow positive. So that's a good thing. You'd want to compare that to other similar businesses. You'd want to compare that to how they've done in previous years. But that's a lot of cash they're generating. I'd like to generate that much cash. It'd be awesome. Investing activities. Bless you. Investing activities. What we're dealing here is with non-current assets. Buying non-current assets, selling non-current assets. So property, machinery, other businesses, these sort of things. Proceeds from the sale of property, plant, and equipment. Payments for property, plant, and equipment. Payments for property, plant, and equipment. So the top 3 items deal with property, plant, and equipment. It's not depreciation on it. It's actually what they've received in cash for selling these things and actually received in cash or paid in cash for buying these things. They received about $840 for selling property, plant, and equipment. And they spent about $2.1 billion on new property, plant, and equipment. What does that tell you? Well, it tells you they're spending money on property, plant, and equipment. Then you'd want to see what strategically that's doing for them, and so on and so on. But they're obviously spending money on shops and on the equipment that they deal with within their shops. Could be on automatic scanning machines, whatever it happens to be. They are spending money. The rest of it, these aren't big items in the scheme of things, but payments for intangible assets, subsidiaries and other businesses, investments. I'll just note here dividends, but these are dividends received. They're not dividends that they are paying, it is dividends that they are receiving. So they have shares in other businesses and they are getting cash flows from those shares. It's not much, but it's there. So you can see, we talk about things not being much. They've received $4.6 million in dividends. It's like, it's not really important. And it's tiny in the big scheme of things. What they've done net is they have invested in property, plant, and equipment. That's really what's driven that $1.3 million net cash outflow. Then when we come to financing activities, these really relate to equity and debt. So equity, so if you've issued new shares, this isn't talking about buying and selling shares like somebody else buying and selling shares on the stock market. This is Woolies issuing shares to the market and getting cash from investors. Or they're buying back shares. That's the equity side of things. You also see dividends turn up down here, and I'll talk more about dividends at this point, at the end as well. So equity, debt, do you borrow money, do you repay money? The interest component on that comes up here. This is just the principal. This is you've just gone off and borrowed new money or repaid it. Now if we look through the amounts, equity, issue of equities, we don't worry about non-controlling interest. So, they got about $175 million from issuing new equity. Not a huge amount in the scheme of things, but it's an amount. The biggest thing by far, proceeds from borrowings, repayment of borrowings. They borrowed about $5 billion and they repaid about 5.2. So whether that's a refinancing or, we don't know the exact details of it at this point, but they haven't really borrowed net. They've borrowed some and repaid some. It's large amounts, but they haven't really changed their situation. So these sort of net out, and what you're left with as the other big amount is dividends paid. So they've paid out in cash $1.5 billion in dividends. And that payment really drives the financing activities being negative. This all sort of nets out. There's a few other bits and pieces, but that 1.5 is basically what drives that. And now we know a little bit more about Woolies' cash flows. Cash flow from operations. So that's, 3.3. So cash flow from operations was positive about 3.3, cash flow from investments negative about 1.3, and cash flow from financing negative about 1.6. Means they brought in terms of the net cash inflows was about $400 million, which you can see. So we understand them a little bit more. A couple of comments around the placement, and these will come up in the slides at some point. Interest and tax and dividends. Whilst a lot of these items in terms of customers and sale of property, plant, and equipment and stuff are specified very specifically where they have to go, interest, tax, and dividends, there is some flexibility in where companies can put them. you will generally see interest and tax being in operations, so up here, and you will generally see dividends paid down here where they are. We won't see, I don't think we really will, we won't see dividends received in this subject, so you don't have to worry about it too much. But just bear in mind that these are generally where they go, they don't have to be there. Once you've got that, you've got the net amount, you've got the start, you've got the end, and that is a cash flow statement. Now, coming back to this point about cash is king. You may still have it, you may have it with you, you may not, but just in case you don't, where is it? Profit for the period. Profit for the period was about 2.1. That represents operationally how you've done from a profit, from a revenue recognition, expense recognition, accrual basis perspective. This represents your operationally how you've done from a cash flow perspective. There's a big difference there. 3.3 to 2.1. Why is that, do you think? There is something which is affecting profit way more than it affects cash flows. And it's a non-cash item. And we have talked about it recently. Maybe even as recently as last week. Louder? Louder. Depreciation. Depreciation expense is one of the biggest things, which is a non-cash expense. What's the entry for depreciation? Debit depreciation expense, credit accumulated depreciation. There is no cash movement there. It's not a cash effect. That would probably be one of the, it's not the only thing, but depreciation is one of them. The other thing which really affects the difference between these two, and this is why people get concerned with profit. Because profit, there are accounting judgments that get made in this, and if people are on the line, you know, imagine you were marking your own papers at the end of this semester. Just imagine that. And imagine you were putting your results in. And imagine you worked it all out properly and you ended up, you were going to put in 49 for the subject. Would you put in 49? Would you maybe try to find an extra mark somewhere to make it 50? Maybe you're much more ethical than I'm giving you credit for, but you might try to find that extra mark in there. So that's the concern people have around profit, is that there are incentives and there's also the ability to do these things to it. Cash is less, unless you're going to move down the sort of the path of fraud. And if you're going to do that, then really there's nothing stopping you doing anything. But we can trust this number probably more than we can trust that number because of that reason. So I just want to show you a quick technique or a quick thing that will show us, I should probably get rid of that. That will show us a way to check this. So I'm going to go to the library and I'm going to look up a database called DAT Analysis. And I'm going to do something really quickly for you guys. And I would highly recommend you picking a company and doing this yourself. And it takes, as you're about to see, it doesn't take very long at all. So I'm going to log in. Okay, If you haven't been in here before, there's a whole bunch of different information that's available for you, but I want to look up Woolworths. And you can do it by code, or you can do it by name or part name. So I'll look up Woolworths, gives me Woolworths. I want to come down to financial data. And what it does is it gives me a 10-year history of their profits, their balance sheets, their cash flows and whatnot. What I'm going to do is to take their profit and loss, come down to reported net profit after abnormals, and I'm just going to copy it. And I've already done it before, so. Okay, so net profit after tax 10 years ago was at just over $1 billion. The most recent one was at 2.1, which is what we've just looked at. I'm going to come back. I'm going to go up to cash flow. I'm going to go down and I'm going to get the operating cash flows and I'm going to copy them and come in, paste them, format it, cash flow from operations. Now, this is where presentation of information is really important. You look at that and you can sort of get something out of it, but it's pretty tricky. Much better if we make it a graph. And we don't need the numbers sitting behind it, we just need to have a look at the graph. So, in the space of a couple of minutes, we now have something to look at. I want to ask you a couple of questions on this. Well, I mean, actually just really one. What are the things which jump out at you when you look at this? When you look at this graph, what are the things that you immediately start to go, like, this is something that I notice? One line's red, one line's blue. I mean, that's one, but this isn't asking for technical analysis on it. Just literally, you look at that and go, oh yeah, that. Yeah, so firstly, one of them seems to be always bigger than the other. In this case, it looks like cash flows are bigger than net profit after tax the whole way through. Why do you think that could be? It's probably for the very same reason we figured out that 1 year difference. Depreciation. They have property all that through time. I would say depreciation is going to be a major driver of that difference. What else do you notice about it? There's not a causal thing in it, so we'll back off from that. But why are you saying they affect each other?
Well, there's similar lines.
Yes, so there's a trend. They look like they're moving in sync. So we're not sort of working on causation here or correlation, because it's basically one number. They're almost the same number with something taken out. There's a really similar trend going on with them. It looks like those lines are really highly correlated. If you've done any correlation work or any statistics work before, there's actually a formal way to check this, or come up with at least with the correlation coefficient. So I'm just going to do that. And if you know much about stats, with a correlation coefficient of 90%, 1 means they're perfectly in sync. 90% is pretty close. That's really good. Yeah, there's a difference, but it's a difference which looks like it's staying constant over time. So that's a really nice thing. What you'd be worried about is if you saw something like that going on. So I've just changed the cash flow numbers. If profit still looks like it's going well, and it's still, with a few blips here and there, still looks like it's trending upwards, and you see cash flow start to tank. Because what that's suggesting is the difference between them is not staying consistent. And that means there's been accounting decisions and accounting choices being made to more aggressively show profit. That's a problem. So if you start to see something like this going on where there's a divergence in terms of how the lines are trending, there may not be an out-and-out problem, but it's certainly a really massive red flag that you'd be like, okay, well, what's going on here? I'd start to get some concerns. So one thing to look at. So just because there's a difference doesn't mean there's a problem. It's when the difference starts to diverge, that's when you've got an issue. All right, so describe the process of preparing the statement of cash flows. The statement of cash flows is prepared with information collected from a variety of sources, including the examination of changes in all non-cash accounts. So what we're going to do, I've given you a handout, we won't look at it just yet, but we are going to step through this entire process. If you think about it, a balance sheet, various assets, including cash, various liabilities, various equities, it balances. That's the point of a balance sheet. Assets equals liabilities plus equity. If the cash figure has changed, it's got to be offset. The rest of that change has to be offset with all the other accounts. So that's why we need all the other accounts. And you'll see how this works as we start to work through it. So we need a comparative statement of financial position, which I've given you guys. You need a statement of comprehensive income, which I've given you guys. And you need additional information as necessary. And for the one that we're going to go through, I haven't provided any of that. It's not necessary for what we're doing at this point, but you could get that information. So the basic structure, have a look at this. So have a look at Woolworths actuals against this structure here. Operating, bless you. Investing, financing. Net increase, cash at the start, cash at the end. It's not like we're trying to teach you something which isn't how it happens. This is how it happens. It's obviously a little bit more complicated here, and there's a few more things going on, and there's some foreign currency movements and whatnot, but the same thing exists. So be comfortable. You know, once you start looking at this, you know what you're looking at in reality. Operating, investing, financing, we've talked about what they are. So let's roll up the sleeves and actually get into this. So prepare the operating activity section of the statement of cash flows. There are two methods for this. The Americans, well, in Australia, as you'll see later on, in Australia we can choose either method for doing this. We used to only be able to choose one, the direct method, and in Australia we actually prefer the direct method, which is completely the opposite to what you see over in the US, where pretty much everyone uses the indirect method. Now, preparers, regulators, investors, pretty much any user group that talks about cash flow statements says they prefer the direct method. We'll go through both, and you figure out what you see is more comfortable. I certainly have a preference, but see what makes more sense to you. But the idea between the two different methods is the starting point. So with the direct method, you start from zero. And we'll do a quick explanation in the class with this. For the indirect method, you start at net profit. So with the direct method, you start at zero and actually look at the cash movements. So if I've given you $100 and you've given me $60, I'd see $100 come in and I'd see $60 go out. With the indirect method, we start at net profit and then adjust it for changes in certain things. So I'll give you a solid example. Okay, so let's say I sold $1,000 worth of stuff to all of you guys in the room, but I did it on account. So none of you guys have paid me yet. So I sold $1,000 worth of whatever it happens to be. Debit account receivable, you owe me money. Credit sales revenue or revenue, I've done some work. Then $900 comes in. Debit cash, 900. Credit account receivable, 900. Everyone okay? We've done this before numerous times. The direct method just looks at, you guys are physically giving me $900. I would have cash from customers, $900. Because I physically have been given $900. For the indirect method, we start at net profit. This, assuming these are the only two transactions that have taken place at all, this is what my profit is, would be my revenue less zero expenses, gives me a profit of 1,000. So I would start at net profit of 1,000, and then I would adjust for the change in account receivable. So if you think about the account receivable account, it's gone from 1,000, debit 1,000, credit 900. It's gone from 0 to 100. It's increased. And we haven't gone through the details of this yet, but that increase means I would deduct the increase on that current asset minus the adjustment of 100 gives me 900. And you can see it does the same thing because I had profit, but I didn't get all of that profit in cash. Some people haven't paid me yet, so we're just taking that 1,000 as a starting point and then adjusting it down to pick up the people that actually paid me. Whereas with the direct method, I'm just going, you guys gave me 900 bucks. That's easy, it's 900. So in a nutshell, the direct method for operating cash flows, the indirect method for operating cash flows. So we'll go through it a little bit more. That's a high-level overview. We'll go through and step through some examples in a sec. Direct and indirect yield the same amount, 900, 900. We can use either. We prefer the direct. Right. So let's do the direct method. Now, this is where I want you to turn to the handout, the other handout that I gave you. So if you have it, just eyeball it quickly while I'm getting out another sheet. What we have is fairly basic income statement. Fairly basic income statement with 10,000 in sales, $2,500 in cost of goods sold, gives you 7,500 gross profit. We've got a gain on sale of 4,000. We've got two expenses, gives us a net profit before tax of 4,800. A tax expense of 13,000, not 13,000, 1,320, gives us net profit after tax of 3,480. Pretty self-explanatory. We've got an opening and a closing amount for assets and liabilities and equity. Cash has gone down by 40. We've got an account receivable, prepaid insurance, inventory and land. I chose land because it wasn't depreciable, just to make life a little bit easier for the moment. Accounts payable, electricity payable, loan, share capital, retained earnings. Start and ending balances. Now what I've tried to choose to do is to pick up amounts which for the most part are similar, either the same or very similar to the amounts in the lecture slides. They might have had to be multiplied by a factor of 10 to make it seem more reasonable. They might have had to be adjusted from millions to thousands, but the idea behind the numbers is very much what you see in the lecture slides. So if you look at the first one, for calculating cash received from sales. Sales during the period, 10,000, increase in accounts receivable, 6,000. So I've kept consistent with that $6,000 increase, but I've just given some numbers behind the start and the end point. So it's gone from 2,000 to 8,000. And then we can see cash received from customers in the period. This is where I'm going to diverge a little bit. I've got nothing wrong with if if anyone wants to choose, if anyone sees this method and continues it on for the other types of cash flows, remembers the formula, they're comfortable with this, if this works for you, this method, please feel free to keep using it. I'm going to show you an alternate method, which I think is actually, as long as you're okay with T accounts, is actually conceptually a lot easier to remember and works without having to remember any complicated formula. Because it's the same process, repeated and repeated and repeated. Actually, I'm going to do it on that screen rather than shoulders playing up. So the way that we do this, so we're looking for operating cash flows. So you'll start to get a sense of the things that you need to put in. T accounts, and we're worried about how we generate for all of these accounts. I'll come back to this. Not cash, but every single one of these other accounts, how they change. They may have a cash effect for the reason they change, they may not, but we need to understand what's going on. And so the best way to do that is with T accounts. So we do the accounts receivable. So account receivable, draw up a T account. I haven't had to think, I just know how to draw a T and write the account over the top of it. I then look at it, put in the opening amount, put in the closing amount. Again, nothing really fancy that's happened there. This is what they call the reconstruction method because it helps us, we're going to use it to reconstruct what's happened based on the information that we have in front of us. Stepping away from this for a second. Imagine, well, it's Thursday night now into a long weekend, so Friday. So Friday night, you guys may be going out. You know, it's a break. You don't have to think about uni for a little while. You may be going out, dinner, drinks, whatnot. Do any of you try to keep a track of what you spend on a night? It just doesn't really matter. You know, I'm a good accountant. I like to have an idea of how much I do spend. You know, is it a bigger night? You spend more? I don't know. But one way that doesn't really work for me is to try to kind of keep note as you spend stuff over the night. Like, you can't go to the bar and you can't always get receipts from places. Like, you certainly can't, you know, if you're buying drinks at the bar for cash, that's not going to happen. Certainly by the end of the night, you probably lost track of you may have lost track of what's going on. So what's another way you can figure out how much you spend on a night, on a holiday, if you can't keep track of it at the time? Chris? Yeah. Exactly. Work out, know what you left the house with, and then check what you came back in with on the next day. So if I left with $100, checked my wallet the next morning, I had 40, sweet, I only spent $60. You can top and tail it, which is basically what we're doing here. We know what we started with, we know what we ended with. Without any other information, I know I spent $60. Without any other information, let's imagine we don't have anything else. This is all that we have. 2,000 to 8,000, explain that. Accounts receivable have gone up by $6,000. So how can that happen? Yeah, we sold, the only explanation for that without anything else is that we sold $6,000 worth of whatever it is, and we received no cash. That is the only thing which explains that. But then, like after a night out, when you find the ATM receipt, and you realize you took out $200, and you're like, oh, okay, this is getting worse. We look for other information. What else do we know? What things affect accounts receivable? We have sales, and we have a number against it. And that number is not 6,000. That number is 10,000. So when we would debit accounts receivable credit sales revenue, we would add that 10,000 to account receivable. It would be debit account receivable. And then you look at that and you go, that doesn't work for me. That plus that doesn't equal $8,000. I'm concerned with this now. $4,000. The only way that this works out is if you have a $4,000 credit to account receivable. And with no other information, what must that be? Well, not pay, well, people paid us. Debit, cash, credit, accounts receivable. That's the only way without other information that could work. Could there be other things which affect account receivable on this side? Absolutely. It could be a write-off of a bad debt. But we have no information about that up here, so we just go, well, we can't say that that happened. So the only thing we can say with certainty based on the information we have to hand is that we have received $4,000, which is the amount that you showed on the slides. So if we were setting this out, and I'm going to do this a little bit roughly, we received from customers 4,000. So that is the cash flow we just worked out. So if we then move to the next slide, I'll come back to this. Inventory purchased during the period 290, increase in account payable 8 means we paid $282,000. Now let's have a look at what's happened here, because I've made the information in front of us a little bit trickier, because I know you guys can handle it. What we don't see, I've multiplied everything by a factor of 10, because otherwise it just look funny. We don't see purchases. We don't see a 2,900 figure anywhere up here. We do see accounts payable increasing by 80. We do see this going from 200 to 280. So that's the 8 times by 10 increase. And we see inventory. So what I want to ask you guys is, how do we calculate that we purchased $2,900 worth of inventory? How do you work out, based on what's in front of you, what your purchase was? How do we know how much inventory we purchased this year? Because there is enough information in front of you to be able to work that out. So the opening and the closing balance of something. Yep. Opening and closing balance. So let's draw up a T account. What account should we look at? Inventory. Yep. And what do we just put in the opening and closing balance? Okay, with no other information, it looks like we have purchased opening of 500, closing of 900. It looks like we have purchased how much? Looks like we've purchased 400. But is that what's happened? What's that? What else affects inventory that we can see? Cost of goods sold. So cost of goods sold. So that's cost of goods sold. So remember, that would be a debit cost of goods sold, credit inventory. 500 minus 2,500 gives you minus 2,000. To go from 2,000 on this side to 900 on this side, you've got to purchase $2,900 worth of inventory. So that's working out the purchase amount. But that's not telling you how much you paid for it. How do you work out what account do we need to look at in relation to payments? Yeah, so if we're looking for where this turns up in the payment section, we would look at the balance for account payable. And that balance has gone from 200 to 280. And we would add, this would be debit inventory expense, debit inventory, credit account payable. 200 plus 2,900 doesn't give you 280. So we need something on this side to make, this is just problem solving. This isn't, in a way, as long as you understand T accounts and debits and credits, this is just problem solving and just piecing information in as needed. 2,820. This plus this minus 2,820 gives you 280 as the balance on this side. And so this is the cash. That's the cash. So received from customers, payment to suppliers. The other thing I should have said is, as you use up the information, highlight, like knock it out in some way to say that you've used it. So the very first one, we use accounts receivable and we use sales, so we don't need that anymore. We then use inventory and we use cost of goods sold. So we don't need inventory or cost of goods sold. We then use accounts payable, so we've dealt with that. We're just sequentially working our way through things. We want to know what our insurance, actually is insurance the next one? I'll have a look. Cash paid for operating expenses accrued. Electricity expense of 5.3, decrease in electricity payable, cash paid for electricity. And this is a really good case in point about why, even though I can't draw properly, I think much more graphically. I need to kind of see it in this sort of way, because once you see it, oh, that doesn't work. I need something over here. It's really easy to visually spot the problem. Whereas to try to remember all the different formulae you need to do this for all the various accounts is actually quite difficult. I'm not saying certain people, if you think that way, use it. But I personally find that hard to do. So I just use the same thing for this. So we look at electricity expenses, we look at the electricity payable. So electricity payable has gone from 800 to 600. It's the same change as what is in the slide. So if we do electricity payable has gone from 800 down to 200. 800 to 200. We've used this. Debit electricity expense, credit electricity payable. So that turns up in here because this is money that we owe to our electricity provider. Plus the money that we owed at the start means we should be paying them $6,100. And what is that? Have I got that? Sorry, it's not 200, it's 600. Yep, my bad. So 800, so we should owe them 6,100. We haven't paid all of that. We've got 600 left over, which means we only paid them 5,500 in cash in that particular year. You see the process is just repetitive. It's just find the account, put in the opening and closing balances, and then add in information as needed. It's payment for electricity minus 5,500. What do we have left? We've got insurance expense. Insurance expense plus or minus a change in the prepaid insurance equals cash paid for insurance. So insurance less the decrease in prepaid insurance gives you cash paid for insurance. And again, there's a formula for it if you want to remember it, but it's so much easier, way easier. I know I'm going to just beat this drum, but I'm going to keep beating this drum. Prepaid insurance has gone from 700 to 300. Prepaid, it's gone from 700 to 300. So we've used that now. Insurance expense is 1,400, so debit insurance expense, credit prepaid insurance. 700 on the debit side, $1,400 on the credit side. This minus this should give us a balance down here of 700. That's not the balance. The balance is 300 on this side, which means we need 1,000 on this side as to new insurance which is being purchased. So 700 plus 1,000 gives you 1,700, minus 1,400 gives you 3. You can see the logic. It's just working through it. What else is left? So that's payment for negative 1,000. And one last thing, even though it's not in here or in here, we have a tax expense, but there's no tax payable at the start, which means we owed no tax at the start of the year and we owed no tax at the end of the year. So we can just conclude from that that tax expense is the amount that we paid during the year. So we can just go payment for tax. And I'll just note this out. And again, I will make this Excel available as I've done with the others later today / tomorrow. And that's it. Those are our operating activities. So received from customers 4,000, payments to suppliers 2,820, payments for electricity 5,500, payments for insurance 1,000, payment for tax 1,320. Whilst you may not have got every single step of the way, the key thing is you basically want to, until you get the hang of it, where in certain cases you don't need to do the T account, you almost want to do a T account for every asset, every liability, every equity other than cash, and then work out how it has changed. That is the process. Once you start to figure out exactly what you need to do, then you don't necessarily have to do the T account, so you can have little cut-throughs to do it, but that's the process behind what you're trying to achieve. Because I look at this, and I've been doing this for a while, and I really struggle trying to figure out what's going on there. Like I find that hard. But again, it's just the way that I think, and I'm not saying that that's a good way, it's a bad way, it's just the way that I do it. Other revenues and expenses in the operating activities section. Depreciation ignored, it's non-cash, it's not a cash flow, it's debit depreciation expense, credit accumulated depreciation. It's just not a cash flow thing. Gain or loss on sales of property, plant, and equipment. We've got a gain on sale. That is not an operating activity. We will see that in the investing activity section, and we'll see how that works out in a moment. So the investing activity section, it's a nice little segue. Prepare the investing activity section of the statement of cash flows. To calculate cash flows from investing activities, all changes in non-current assets must be examined. So you just go into non-current assets, whatever's left, land, property, plant, and equipment, whatever it is, and just try to figure out what's caused the change. If we tell you nothing, if there is no additional information, you can assume whatever change has happened is due to cash, as in you've bought something for cash or you've sold something for cash. That's not always the case. You can buy things for some sort of other consideration, you can sell things, that's not always going to be the case. But assume the default position is if something changes and you aren't told anything else, cash is driving it. So cash flows from investing activities from sales of things, cash outflows include purchase of property, plant, and equipment, investment, so on. We talked about interest and dividends, generally classified as operating activities, although we did see in Woolworths that dividends received were in investing activities. It's a general thing. It's not necessarily exactly the case for each particular company. All right, so let's have a look at land. I need you guys to help me out with this. Land, I'm just going to start it off and then I'm going to let you guys have a crack. Land starts at 5,500, ends at 5,000. That is just simply the change from open to close. Oops. So how much cash have we got from doing whatever, or how much cash have we got or paid for whatever we've done with land? 500. Okay. What does the 500 mean? Okay, let's back this out a bit. So we know, let's work through sequentially what we know. What we know is that land, the account, has dropped by 500. We're not talking based on this. So we have a credit to land of 500. Now that would generally, for what we're doing here, that would generally mean that we have sold land. So what does the entry for that look like? So we'll do the credit land. All right. So what do we do? So debit, cash, and how much? 500? All right. That would be bang on if there was no other information. But is there other information? Exactly. There is a gain on sale. So when we turn to the income statement, which is why it's good to sort of knock things off, or like to tick them off, or rule a line through them, whatever you do when you go through this, because we see there's a gain on sale. So how does this affect that? What would hello? Yeah, nothing's. What would a gain on sale look like as an entry? And again, it's not revenue, but think of it in a similar way as revenue. So when we have revenue, is it a debit or a credit? It's a credit. So when we have a gain, which is kind of like revenue, sort of, that will then be a credit. So we credit gain 4,000. Do we have to do anything to this? Debit cash. Exactly. So if there wasn't a gain on sale, there doesn't always have to be, it could be at book value. If there's a gain on sale, then that's what the entry looks like. And the amount of cash that you got is $4,000 more than what the value of the land in your books was sold at. So in this case, we have taken account of the land and we've taken account of the gain on sale. And so we'd have investing, sale of land, 4,500. So sale of land is 4,500 and it's positive because we have received cash from selling it. And again, it's the same process. We've done the account and we moved on. And look, the very last one, leave that over here. The very last one is the the financing section. Prepare the financing activity section of the statement of cash flows. To calculate cash flows from financing activities, the balances for non-current liabilities, equity accounts, and dividends must be examined. So what's left? Let's have a look, let's eyeball the income statement for a second. It's just the net, it's just the totals which are left. So we've kind of, in a sense, we've done everything there. We haven't touched cash, and that's fine because cash is what we're actually trying to figure out what's going on. We have a liability through loan, we have share capital, and we've got retained earnings. So I'm going to come over here a bit. Financing. Without doing the T accounts, because I think we can do 2 of them without doing the T accounts. The loan has gone from 1,000 to 5,000. So what does that mean from a cash flow point of view? We've borrowed money. Yep, so we borrowed money, and how much have we borrowed? 4,000. That's a really not official way to say it, but we borrowed money, 4,000. With share capital, it's gone from 5,000 to 4,500. It's gone down. So does that mean, so what does that mean is likely to have been the case? Okay. In that, it's likely to be something like a share buyback, where they have, instead of issuing shares, they've bought back some of the shares that are out there. And without additional information, we can only assume that they've done so at the issue price. You know, we don't know anything else. So we bought back shares, and we bought back 500, because that's just, you can see it's gone from 5,000 to 4,500. Now the last one, and I know you know how to do this, because we've done these sort of things before, even though it's not in this context. So let's, I want you to work out what the amount of dividends paid was. I'm going to put it back on the information. I want you to spend a minute or 2 and work out what the amount of dividends. So there were dividends paid, even though it doesn't say anything about dividends in there. There's no explicit information about it. You can work it out. You have enough information. Cool. All right, looks like quite a few people are getting there. So in the interest of time, this is probably one where a T account is useful. Retained earnings. And if we look at what we haven't used yet, retained earnings is the change in that account is what's left. Opens at 2,000, closes at 4,008 and 4,080. What goes into retained earnings? Not cash. Profit. Profit goes in. Profit goes in. 2,000 plus 3,480 would give you 5,480. What comes out of retained earnings? Dividends. So the gap that we need, so this is like a microcosm of your change in retained earnings statement. Your opening retained earnings plus profit minus dividends gives you closing retained earnings. It's the same thing. The amount that we need is 1,400. That's the amount that would balance it all out. So dividends paid minus 1,400. Tidy up the formatting, make it look all pretty. Sum it all out. That's all a bit small. Hang on. Amazing. Well, I think everyone can see that. The change, adding them up, is negative 40. So when we've done the separate sections, and I know investing in financing, they didn't even have numbers in the slides, and I think this is better to actually go through some numbers rather than just talk about it in the abstract. But you can see once we've done the operating, investing, and financing, we get to minus 40 as the net effect. Cash goes from 300 to 260. That's your minus 40. Yes. It's good. So we've gone through a really long-winded process to come out with that minus $40, which is what we're after. which is good. It's always nice when things work out. In terms of the lecture demonstration, look, the first one, it's not even calculating numbers out. It's just literally putting items where they need to be. And even the template has almost where they have to go. So I'm not going to touch that. The indirect method is better in the sense that you're actually calculating numbers out. But instead of using the numbers in there, and I will leave them so you can do the indirect method demonstration as another piece of homework if you want to do that, because I've got the solutions there as well. I'm going to show the indirect method using this set of information, because what I want to do is show you how you get 6,640 as a net cash outflow using the direct method, and I want to show you how you get the same number using the indirect method. So the idea behind the indirect method, so we'll get to that. This is the other way. When reporting operating cash flows under the indirect method, companies report net cash flows from operating activities by adjusting profit. There are three main types of adjustments. Non-cash effects, depreciation, that's the biggest one there. Now we don't have depreciation in this example, but generally speaking that would be the biggest one. Gains and losses from investing activities. If you have a gain, it will appear in the, or a gain or a loss, it will appear in the profit and loss statement. It does appear in the income statement and it does affect net profit, but it doesn't go into the operating section of the cash flow statement. It goes into the investing section. So we need to strip it out. And thirdly, we need to account for changes in current assets and current liabilities. So I'll talk through what this means. Depreciation is typically the biggest. Profit may include a gain. Okay. Yep. That's just talking about the gain or loss that needs to be stripped out. So we don't need to talk about that too much. So the format, and I'm going to show you Woolies in a second. Net income, add depreciation, adjust for any sales, gains or losses, adjust for changes in operating assets, adjust for changes in operating liabilities. Start with net income, end with net cash flow from operations. So if we look at Woolies, and I come down to, you won't have this slide because this is later on, this is note 23. I just want you to pay attention to how that looks against the format that in the slides. Profit after income tax expense, 2.1. That's the profit figure. That's the starting point. The ending figure is net cash provided by operating activities is the 3.3. We've seen those two numbers before. So all that they're doing is starting at this point and making a whole bunch of adjustments to get to cash flow from operations. And if you look at the adjustments up there, depreciation and amortization is the biggest one by far. They're adding back for a net loss because that affects profit, but it's not an operating activity for cash flows. Payables, receivables, inventories, payables. Current assets, current liabilities that we are comfortable with. So this is, with a few more details and a bit more sort of complications in there, it's doing the same thing that we're used to. Now the thing is, these figures should match up. Everything should cross-check, which led me to, I remembered an article from 7 years ago from a company from our friends from across the ditch. This is a New Zealand company. And in their financial report that they sent to the market, went out publicly, if you went to their reconciliation for cash flows, net loss for the year, we know that's a starting point, or net profit. Adjust for depreciation is usually the first thing. Fair enough. The first thing that they had was adjust for depreciation, fudge this to equal something else. They had included the words that they had to fudge this number in a formal document they sent to the stock exchange. Not a great look. Now it was an internal error which shouldn't have gone out, but one of those things. I thought I'd just bring it up because I found it funny at the time, and it still kind of is. So what are we doing in the 10 minutes or so that we have? Let's have a look at these numbers. So net profit, that's our starting point. What we're doing from net profit is then adjusting for non-cash items like depreciation. No depreciation, that's easy, we don't have to do anything. We adjust for gains and losses. We have a gain. So we would we would deduct gain. Oh, that's going to come up in funny formats. Deduct gain on sale, and I'll all right. So deduct gain on sale minus 4,000. I'll get these so we can see the colors a bit better. Now what we're doing then is looking at current assets, so account receivable, prepaid, and inventory, and accounts payable and electricity payable. We are then adjusting for changes in these. So account receivable has increased by 6,000, prepaid insurance has decreased by 400, inventory has increased by 400. Accounts payable has increased by 80, and electricity payable has decreased by 200. So how do we change what's happened here? If you're think about it this way, use one, you say account receivable and an increase. Once you've pegged one, you can work everything out from that. So if you have account receivable increasing, think about my earlier example. I sold $1,000 worth of stuff to you. My account receivable increased by 100. I collected 900. Even though my profit was 1,000, I only collected 900. So if I have an account receivable increasing, it means I haven't received as much cash as the revenue that I have reported. So if I've got an increase in an account receivable, I need to deduct for an increase in account receivable. And then you can just base everything on that idea. So when a current asset goes up, you deduct it. When a current asset goes down, you add it. So prepaid insurance has gone down, so we add decrease in prepaid insurance. And that's gone 400, we'd have to add 400. Inventory has gone up, so we deduct increase in inventory by 400. And then we flip that idea around for accounts payable. If your accounts payable has gone up, it means you owe people more than what you started with, which means you haven't paid them as much cash as you should have. So accounts payable has gone up, so that means it's increasing. That means we add an increase in account payable, and that's 80. And electricity payable has gone down, which means we've actually paid more than what our expense was, so we need to subtract or deduct. Electric payable, 200. And fingers crossed, because it's always a bit of a hairy time just in case it's gone wrong. We sum all of this. Da-ding. It's always nice when that happens because you're never quite sure if you stuff something up along the way. So again, gains and losses are relatively straightforward to figure out what you do with them. But for all the changes in these things, remember one. Remember what you do with an account receivable. And that means you know how to deal with assets. Then you can deal with liabilities just by flipping the changes, and you can work it through. It is something which is going to require a bit of practice and just working through. I'm not going to lie about that. But that's the idea behind it. Start at profit and then adjust things out over time, and you get to the same point. 6,640, 6,640 negative. That's what we want. It's the same operating cash flow, it's just worked out different ways. And the final thing. So again, that demonstration is a different one using different numbers. You have a solution at the back. Use that as practice. You can also have disclosures for non-cash investing activities. So if you've bought something and paid for it in a way other than cash, it wouldn't go in the cash flow statement, but you'll see it disclosed somewhere else. And that's it. That is cash flow statements.